Moreover, we continue to pour huge sums of money into our operations to not only prepare for the future, but also make these operations more environmentally friendly. Since we purchased Mid-American 10 years ago, ETH has never paid a dividend. We have instead used earnings to improve and expand our properties in each of the territories we serve. As one dramatic example, in the last 3 years, our Iowa and Western utilities have earned $2.5 billion, while in this same period spending $3 billion on wind generation facilities. Mid-American has consistently kept its end of the bargain with society, and, to society's credit, it has reciprocated. With few exceptions, our regulators have promptly allowed us to earn a fair return on the ever-increasing sums of capital we must invest. Going forward, we will do whatever it takes to serve our territories in the manner they expect. We believe that, in turn, we will beload the return we deserve on the funds we invest. In earlier days, Charlie and I shunned capital-intensive businesses such as public utilities. Indeed, the best businesses by far for owners continue to be those that have high returns on capital and that require little incremental investment to grow. We are fortunate to own a number of such businesses, and we would love to buy more. Anticipating, however, that Berkshire will generate ever-increasing amounts of cash, we are today quite willing to enter businesses that regularly require large capital expenditures. We expect that these businesses have reasonable expectations of earning decent returns on the incremental sums they invest. If our expectations are met, and we believe that they will be, Berkshire's ever-growing collection of good to great businesses should produce above average, though certainly not spectacular, returns in the decades ahead. Our BNSF operation, it should be noted, has certain important economic characteristics that resemble those of our electric utilities. In both cases, we provide fundamental services that are, and will remain, essential to the economic well-being of our customers, the communities we serve, and indeed the nation. Both will require heavy investment that greatly exceeds depreciation allowances for decades to come. Both must also plan far ahead to satisfy demand that is expected to outstrip the needs of the past. Finally, both require wise regulators who will provide certainty about allowable returns so that we can confidently make the huge investments required to maintain, replace and expand the plant. We see a social compact existing between the public and our railroad business, just as is the case with our utilities. If either side shirks its obligations, both sides will inevitably suffer. Therefore, both parties to the compact should, and we believe, will understand the benefit of behaving in a way that encourages good behavior by the other. It is inconceivable that our country will realize anything close to its full economic potential without its possessing first-class electricity and railroad systems. We will do our part to see that they exist. In the future, BNSF results will be included in this regulated utility section. Aside from the two businesses having similar underlying economic characteristics, both are logical users of substantial amounts of debt that is not guaranteed by Berkshire. Both will retain most of their earnings. Both will earn and invest large sums in good times or bad, though the railroad will display the greater cyclicality. Overall, we expect this regulated sector to deliver significantly increased earnings over time, albeit at the cost of our investing many tens of billions of dollars of incremental equity, capital, manufacturing, service and retailing operations. Our activities in this part of Berkshire cover the waterfront. Let's look, though, at a summary balance sheet and earnings statement for the entire group. Almost all of the many and widely diverse operations in this sector suffered to one degree or another from 2009's severe recession. The major exception was McLean, our distributor of groceries, confections, and non-food items to thousands of retail outlets, the largest by far Walmart. Grady Rosier led McLean to record pre-tax earnings of $344 million, which have so amounted to only slightly more than 1 cent per dollar on its huge sales of $31.2 billion. McLean employs a vast array of physical assets, practically all of which it owns, including 3,242 trailers, 2,309 tractors and 55 distribution centers with 15.2 million square feet of space. McLean's prime asset, however, is Grady. We had a number of companies at which profits improved even as sales contracted, always an exceptional managerial achievement. Here are the CEOs who made it happen. Among the businesses we own that have major exposure to the depressed industrial sector, both Marmon and Isker turned in relatively strong performances. Frank Tax Marmon delivered a 13.5% pre-tax profit margin, a record high. Though the company's sales were down 27%, Frank's cost-conscious management mitigated the decline in earnings. Nothing stops Israel-based Iskar, not wars, recessions, or competitors. The world's two other leading suppliers of small cutting tools both had very difficult years, each operating at a loss throughout much of the year. Though Iskar's results were down significantly from 2008, the company regularly reported profits, even while it was integrating and rationalizing Tungaloy, the large Japanese acquisition that we told you about last year. When manufacturing rebounds, Iskar will set new records. Its incredible managerial team of Eitan Wertheimer, Jacob Harpaz, and Danny Goldman will see to that. Every business we own that is connected to residential and commercial construction suffered severely in 2009. Combined pre-tax earnings of Shaw, Johns Manville, Acme Brick, and Mytech were $227 million, an 82.5% decline from $1.295 billion in 2006, when construction activity was booming. These businesses continue to bump along the bottom, though their competitive positions remain undented. The major problem for Berkshire last year was NetJets, an aviation operation that offers fractional ownership of jets. Over the years, it has been enormously successful in establishing itself as the premier company in its industry, with the value of its fleet far exceeding that of its three major competitors combined. Overall, our dominance in the field remains unchallenged. NetJet's business operation, however, has been another story. In the 11 years that we have owned the company, it has recorded an aggregate pre-tax loss of $157 million. Moreover, the company's debt has soared from $102 million at the time of purchase to $1.9 billion in April of last year. Without Berkshire's guarantee of this debt, NetJets would have been out of business. It's clear that I failed you in letting NetJets descend into this condition. But, luckily, I have been bailed out. Dave Sokol, the enormously talented builder and operator of Mid-American Energy, became CEO of NetJets in August. His leadership has been transforming. Debt has already been reduced to $1.4 billion, and, after suffering a staggering loss of $711 million in 2009, the company is now solidly profitable. Most important, none of the changes wrought by Dave have in any way undercut the top-of-the-line standards for safety and service that Rick Santulli, NetJet's previous CEO and the father of the fractional ownership industry, insisted upon. Dave and I have the strongest possible personal interest in maintaining these standards because we and our families use NetJets for almost all of our flying, as do many of our directors and managers. None of us are assigned special planes nor crews. We receive exactly the same treatment as any other owner, meaning we pay the same prices as everyone else does when we are using our personal contracts. In short, we eat our own cooking. In the aviation business, no other testimonial means more. Finance and financial products. Our largest operation in this sector is Clayton Homes, the country's leading producer of modular and manufactured homes. Clayton was not all number one. A decade ago, the three leading manufacturers were Fleetwood, Champion, and Oakwood, which together accounted for 44% of the output of the industry. All have since gone bankrupt. Total industry output, meanwhile, has fallen from 382,000 units in 1999 to 60,000 units in 2009. The industry is in shambles for two reasons, the first of which must be lived with if the U.S. economy is to recover. This reason concerns U.S. housing starts, including apartment units. In 2009, starts were 554,000, by far the lowest number in the 50 years for which we have data. Paradoxically, this is good news. People thought it was good news a few years back when housing starts, the supply side of the picture, were running about 2 million annually. But household formations, the demand side, only amounted to about 1.2 million. After a few years of such imbalances, the country unsurprisingly ended up with far too many houses. There were three ways to cure this overhang. 1. Blow up a lot of houses, a tactic similar to the destruction of autos that occurred with the Cash for Clunkers program. 2. Speed up household formations by, say, encouraging teenagers to cohabitate, a program not likely to suffer from a lack of volunteers. Or 3. Reduce new housing starts to a number far below the rate of household formations. Our country has wisely selected the third option, which means that within a year or so residential housing problems should largely be behind us, the exceptions being only high-value houses, and those in certain localities where overbuilding was particularly egregious. Prices will remain far below bubble levels, of course, but for every seller, or lender, hurt by this. There will be a buyer who benefits. Indeed, many families that couldn't afford to buy an appropriate home a few years ago now find it well within their means because the bubble burst. The second reason that manufactured housing is troubled is specific to the industry: the punitive differential in mortgage rates between factory-built homes and site-built homes. Before you read further, let me underscore the obvious. Berkshire has a dog in this fight, and you should therefore assess the commentary that follows with special care. That warning made, however, let me explain why the rate differential causes problems for both large numbers of lower-income Americans and Clayton. The residential mortgage market is shaped by government rules that are expressed by FHA, Freddie Mac, and Fannie Mae. Their lending standards are all powerful because the mortgages they insure can typically be securitized and turned into what, in effect, is an obligation of the U.S. government. Currently, buyers of conventional site-built homes who qualify for these guarantees can obtain a 30-year loan at about 0.25%. In addition, these are mortgages that have recently been purchased in massive amounts by the Federal Reserve, an action that also helped to keep rates at bargain basement levels. In contrast, very few factory-built homes qualify for agency-insured mortgages. Therefore, a meritorious buyer of a factory-built home must pay about 9% on his loan. For the all-cash buyer, Clayton's homes offer terrific value. If the buyer needs mortgage financing, however, and of course, most buyers do, the difference in financing costs too often negates the attractive price of a factory-built home. Last year I told you why our buyers, generally people with low incomes, performed so well as credit risks. Their attitude was all important. They signed up to live in the home, not resell or refinance it. Consequently, our buyers usually took out loans with payments geared to their verified incomes. We weren't making liar's loans, and looked forward to the day they could burn their mortgage. If they lost their jobs, had health problems, or got divorced, we could of course expect defaults. But they seldom walked away simply because house values had fallen. Even today, though job loss troubles have grown, Clayton's delinquencies and defaults remain reasonable and will not cause us significant problems. We have tried to qualify more of our customers' loans for treatment similar to those available on the site-built product. So far we have had only token success. Many families with modest incomes but responsible habits have therefore had to forego home ownership simply because the financing differential attached to the factory-built product makes monthly payments too expensive. If qualifications aren't broadened so as to open low-cost financing to all who meet down payment and income standards, the manufactured home industry seems destined to struggle and dwindle. Even under these conditions, I believe Clayton will operate profitably in coming years, though well below its potential. We couldn't have a better manager than CEO Kevin Clayton, who treats Berkshire's interests as if they were his own. Our product is first class, inexpensive, and constantly being improved. Moreover, we will continue to use Berkshire's credit to support Clayton's mortgage program, convinced as we are of its soundness. Even so, Berkshire can't borrow at a rate approaching that available to government agencies. This handicap will limit sales, hurting both Clayton and a multitude of worthy families who long for a low-cost home. In the following table, Clayton's earnings are net of the company's payment to Berkshire for the use of its credit. Offsetting this cost to Clayton is an identical amount of income credited to Berkshire's finance operation and included in other income. The cost and income amount was $116 million in 2009 and $92 million in 2008. The table also illustrates how severely our furniture, court and trailer leasing operations have been hit by the recession. Though their competitive positions remain as strong as ever, we have yet to see any bounce in these businesses. At the end of 2009, we became a 50% owner of Berkshire Commercial Mortgage, formerly known as Capmark, the country's third-largest servicer of commercial mortgages. In addition to servicing a $235 billion portfolio, the company is an important originator of mortgages, having 25 offices spread around the country. Though commercial real estate will face major problems in the next few years, long-term opportunities for Berkshire are significant. Our partner in this operation is Leucadia, run by Joe Steinberg and Ian Cumming, with whom we had a terrific experience some years back when Berkshire joined with them to purchase Finova, a troubled finance business. In resolving that situation, Joe and Ian did far more than their share of the work, an arrangement I always encourage. Naturally, I was delighted when they called me to partner again in the Capmark purchase. Our first venture was also christened Berkshire. So let's call this one Son of Berkshire. Someday I'll be writing you about grandson of Berkshire. Investments. Below, we show our common stock investments that at year-end had a market value of more than $1 billion. In addition, we own positions in non-traded securities of Dow Chemical, General Electric, Goldman Sachs, Swiss Re and Wrigley, with an aggregate cost of $21.1 billion and a carrying value of $26.0 billion. We purchased these 5 positions in the last 18 months. Setting aside the significant equity potential they provide us, these holdings deliver us an aggregate of $2.1 billion annually in dividends and interest. Finally, we own 76,777,029 shares, 22.5% of BNSF at year-end, which we then carried at $85.78 per share, but which have subsequently been melded into our purchase of the entire company. In 2009, our largest sales were in ConocoPhillips, Moody's, Procter & Gamble, and Johnson & Johnson, sales of the latter occurring after we had built our position earlier in the year. Charlie and I believe that all of these stocks will likely trade higher in the future. We made some sales early in 2009 to raise cash for our Dow and Swiss Re purchases, and late in the year made other sales in anticipation of our BNSF purchase. We told you last year that very unusual conditions then existed in the corporate and municipal bond markets, and that these securities were ridiculously cheap relative to U.S. Treasuries. We backed this view with some purchases, but I should have done far more. Big opportunities come infrequently. When it's raining gold, reach for a bucket, not a thimble. We entered 2008 with $44.3 billion of cash equivalents, and we have since attained operating earnings of $17 billion. Nevertheless, at year-end 2009, our cash was down to $30.6 billion, with $8 billion earmarked for the BNSF acquisition. We've put a lot of money to work during the chaos of the last 2 years. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. In the end, what counts in investing is what you pay for a business through the purchase of a small piece of it in the stock market, and what that business earns in the succeeding decade or two. Last year I wrote extensively about our derivatives contracts, which were then the subject of both controversy and misunderstanding. For that discussion, please go to www.berkshirehathaway.com. We have since changed only a few of our positions. Some credit contracts shave runoff. The terms of about 10% of our equity put contracts have also changed. Maturities have been shortened and strike prices material reduced. In these modifications, no money changed hands. A few points from last year's discussion are worth repeating. Though it's no sure thing, I expect our contracts in aggregate to deliver us a profit over their lifetime, even when investment income on the huge amount of float they provide us is excluded in the calculation. Our derivatives float, which is not included in the $62 billion of insurance float I described earlier, was about $6.3 billion at year-end. 2. Only a handful of our contracts require us to post collateral under any circumstances. At last year's low point in the stock and credit markets, our posting requirement was $1.7 billion, a small fraction of the derivatives-related float we held. When we do post collateral, let me add, the securities we put up continue to earn money for our account. 3. Finally, you should expect large swings in the carrying value of these contracts, items that can affect our reported quarterly earnings in a huge way, but that do not affect our cash or investment holdings. That thought certainly fit 2009 circumstances. Here are the pre-tax quarterly gains and losses from derivatives valuations that were part of 4 reported earnings last year. As we've explained, these wild swings neither cheer nor bother Charlie and me. When we report to you, we will continue to separate out these figures, as we do realized investment gains and losses, so that you can more clear view the earnings of our operating businesses. We are delighted that we hold the derivatives contracts that we do. To date, we have significantly profited from the float they provide. We expect also to earn further investment income over the life of our contracts. We have long invested in derivatives contracts that Charlie and I think are mispriced, just as we try to invest in mispriced stocks and bonds. Indeed, we first reported to you that we held such contracts in early 1998. The dangers that derivatives pose for both participants and society, dangers of which we've long warned, and that can be dynamite, arise when these contracts lead to leverage or counterparty risk that is extreme. At Berkshire, nothing like that has occurred, nor will it. It's my job to keep Berkshire far away from such problems. Charlie and I believe that a CEO must not delegate risk control, It's simply too important. At Berkshire, I both initiate and monitor every derivatives contract on our books, with the exception of operations-related contracts at a few of our subsidiaries such as Mid-American and the minor runoff contracts at General Re. If Berkshire ever gets in trouble, it will be my fault. It will not be because of misjudgments made by a risk committee or chief risk officer. In my view, a board of directors of a huge financial institution is derelict if it does not insist that its CEO bear full responsibility for risk control. If he's incapable of handling that job, he should look for other employment. And if he fails at it, with the government thereupon required to step in with funds or guarantees, the financial consequences for him and his board should be severe. It has not been shareholders who have botched the operations of some of our country's largest financial institutions. Yet they have borne the burden, with 90% or more of the value of their holdings wiped out in most cases of failure. Collectively, they have lost more than $500 billion in just the 4 largest financial fiascos of the last 2 years. To say these owners have been bailed out is to make a mockery of the term. The CEOs and directors of the failed companies, however, have largely gone unscathed. Their fortunes may have been diminished by the disasters they oversaw, but they still live in grand style. It is the behavior of these CEOs and directors that needs to be changed. If their institutions and the country are harmed by their recklessness, they should pay a heavy price, one not reimbursable by the companies they've damaged, nor by insurance. CEOs and, in many cases, directors have long benefited from oversized financial carrots. Some meaningful sticks now need to be part of their employment picture as well. An inconvenient truth: boardroom overheating. Our subsidiaries made a few small bolt-on acquisitions last year for cash, but our blockbuster deal with BNSF required us to issue about 95,000 Berkshire shares that amounted to 6.1% of those previously outstanding. Charlie and I enjoy issuing Berkshire stock about as much as we relish prepping for a colonoscopy. The reason for our distaste is simple. If we wouldn't dream of selling Berkshire in its entirety at the current market price, why in the world should we sell a significant part of the company at that same inadequate price by issuing our stock in a merger? In evaluating a stock-for-stock offer, shareholders of the target company quite understandably focus on the market price of the acquirer's shares that are to be given them. But they also expect the transaction to deliver them the intrinsic value of their own shares, the ones they are giving up. If shares of a prospective acquirer are selling below their intrinsic value, it's impossible for that buyer to make a sensible deal in an all-stock deal. You simply can't exchange an undervalued stock for a fully valued one without hurting your shareholders. Imagine, if you will, Company A and Company B, of equal size and both with businesses intrinsically worth $100 per share. Both of their stocks, however, sell for $80 per share. The CEO of A, long on confidence and short in smarts, offers 100 quarter shares of A for each share of B, correctly telling his directors that B is worth $100 per share. He will neglect to explain, though, that what he is giving will cost his shareholders $125 in intrinsic value. If the directors are mathematically challenged as well, and a deal is there completed, the shareholders of B will end up owning 55.6% of A and B's combined assets, and A's shareholders will own 44.4%. Not everyone at A, it should be noted, is a loser from this nonsensical transaction. Its CEO now runs a company twice as large as his original domain, in a world where CISA tends to correlate with both prestige and compensation. If an acquirer's stock is overvalued, it's a different story. Using it as a currency works to the acquirer's advantage. That's why bubbles in various areas of the stock market have invariably led to serial issuances of stock by promoters. Going by the market value of their stock, they can afford to overpay because they are, in effect, using counterfeit money. Periodically, many heir for assets acquisitions have taken place, the late 1960 seconds having been a particularly obscene period for such chicanery. Indeed, certain large companies were built in this way. No one involved, of course, ever publicly acknowledges the reality of what is going on, though there is plenty of private snickering. In our BNSF acquisition, the selling shareholders quite properly evaluated our offer at $100 per share. The cost to us, however, was somewhat higher since 40% of the $100 was delivered in our shares, which Charlie and I believed to be worth more than their market value. Fortunately, we had long owned a substantial amount of BNSF stock that we purchased in the market for cash. All told, therefore, only about 30% of our cost overall was paid with Berkshire shares. In the end, Charlie and I decided that the disadvantage of paying 30% of the price through stock was offset by the opportunity the acquisition gave us to deploy $22 billion of cash in a business we understood and liked for the long term. It has the additional virtue of being run by Matt Rose, whom we trust and admire. We also like the prospect of investing additional billions over the years at reasonable rates of return, but the final decision was a close one. If we had needed to use more stock to make the acquisition, it would in fact have made no sense. We would have then been giving up more than we were getting. I have been in dozens of board meetings in which acquisitions have been deliberated, often with the directors being instructed by high-price investment bankers. Are there any other kind? Invariably, the bankers give the board a detailed assessment of the value of the company being purchased, with emphasis on why it is worth far more than its market price. In more than 50 years of board memberships, however, never have I heard the investment bankers or management discuss the true value of what is being given. When a deal involved the issuance of the acquirer's stock, they simply used market value to measure the cost. They did this, even though they would have argued that the acquirer's stock price was woefully inadequate. Absolutely no indicator of its real value had a takeover bid for the acquirer instead been the subject up for discussion. When stock is the currency being contemplated in an acquisition, and when directors are hearing from an advisor, it appears to me that there is only one way to get a rational and balanced discussion. Directors should hire a second advisor to make the case against the proposed acquisition, with its fee contingent on the deal not going through. Absent this drastic remedy, our recommendation in respect to the use of advisors remains. Don't ask the barber whether you need a haircut. I can't resist telling you a true story from long ago. We owned stock in a large well-run bank that for decades had been statutorily prevented from acquisitions. Eventually, the law was changed, and our bank immediately began looking for possible purchases. Its managers, fine people, and able bankers, not unexpectedly began to behave like teenage boys who had just discovered girls. They soon focused on a much smaller bank, also well-run, and having similar financial characteristics in such areas as return on equity, interest margin, loan quality, etc. Our bank sold at a modest price, that's why we had bought into it, hovering near book value and possessing a very low price-earnings ratio. Alongside, though, the small bank owner was being wooed by other large banks in the state and was holding out for a price close to 3 times book value. Moreover, he wanted stock, not cash. Naturally, our fellows caved in and agreed to this value-destroying deal. We need to show that we are in the hunt. Besides, it's only a small deal, they said, as if only major harm to shareholders would have been a legitimate reason for holding back. Charlie's reaction at the time: are we supposed to applaud because the dog that fouls our lawn is a Chihuahua rather than a Saint Bernard? The seller of the smaller bank, no fool, then delivered one final demand in his negotiations. After the merger, he in effect said, perhaps using words that were phrased more diplomatically than these: I'm going to be a large shareholder of your bank, and it will represent a huge portion of my net worth. You have to promise me, therefore, that you'll never again do a deal this dumb. Yes, the merger went through. The owner of the small bank became richer, we became poorer, and the managers of the big bank, newly bigger, lived happily ever after. The annual meeting. Our best guess is that 35,000 people attended the annual meeting last year, up from 12 no zeros omitted in 1981. With our shareholder population much expanded, we expect even more this year. Therefore, we will have to make a few changes in the usual routine. There will be no change, however, in our enthusiasm for having you attend. Charlie and I like to meet you, answer your questions, and best of all, have you buy lots of goods from our businesses. The meeting this year will be held on Saturday, May 1st. As always, the doors will open at the QS Center at 7 a.m., and a new Berkshire movie will be shown at 8:30. At 9:30 we will go directly to the question and answer period, which, with a break for lunch at the QS stands, will last until 3:30. After a short recess, Charlie and I will convene the annual meeting at 3:45. If you decide to leave during the day's question periods, please do so while Charlie is talking. Act fast. He can be terse. The best reason to exit, of course, is to shop. We will help you do that by filling the 194,300 square foot hall that adjoins the meeting area with products from dozens of Berkshire subsidiaries. Last year you did your part, and most locations racked up record sales. But you can do better. A friendly warning: If I find sales are lagging, I get testy and lock the exits. Geico will have a booth staffed by a number of its top counselors from around the country, all of them ready to supply you with auto insurance quotes. In most cases, Geico will be able to give you a shareholder discount, usually 8%. This special offer is permitted by 44 of the 51 jurisdictions in which we operate. One supplemental point: the discount is not additive if you qualify for another, such as that given certain groups. Bring the details of your existing insurance and check out whether we can save you money. For at least 50% of you, I believe we can. Be sure to visit the Bookworm. Among the more than 30 books and DVDs it will offer are 2 new books by my sons. Howard's Fragile, a volume filled with photos and commentary about lives of struggle around the globe, and Peter's Life is What You Make It. Completing the family trilogy will be the debut of my sister Doris's biography, a story focusing on her remarkable philanthropic activities. Also available will be Poor Charlie's Almanac, the story of my partner. This book is something of a publishing miracle never advertised, yet year after year selling many thousands of copies from its internet site. Should you need to ship your book purchases, a nearby shipping service will be available. If you are a big spender, or for that matter, merely a gawker, visit Elliott Aviation on the east side of the Omaha airport between noon and 5:00 p.m. on Saturday. There we will have a fleet of NetJets aircraft that will get your pulse racing. An attachment to the proxy material that is enclosed with this report explains show you can obtain the credential you will need for admission to the meeting and other events. As for plane, hotel and car reservations, we have again signed up American Express 800-799-6634 to give you special help. Carol Pedersen, who handles these matters, does a terrific job for us each year, and I thank her for it. Hotel rooms can be hard to find, but work with Carol and you will get one. At Nebraska Furniture Mart, located on a 77-acre site on 72nd Street between Dodge and Pacific, we will again be having Berkshire weekend discount pricing. To obtain the Berkshire discount, you must make your purchases between Thursday, April 29th and Monday, May 3rd inclusive, and also present your meeting credential. The period special pricing will even apply to the products of several prestigious manufacturers that normally have ironclad rules against discounting, but which, in the spirit of our shareholder weekend, have made an exception for you. We appreciate their cooperation. NFM is open from 10 a.m. to 9 p.m., Monday through Saturday, and 10 a.m. to 6 p.m. on Sunday. On Saturday this year, from 5:30 p.m. to 8 p.m., NFM's having a Berkeyville BBQ, to which you are all invited. At Borsheim's, we will again have 2 shareholder-only events. The first will be a cocktail reception from 6 p.m. to 10 p.m. on Friday, April 30th. Second, the main gala, will be held on Sunday, May 2nd, from 9 a.m. to 4 p.m. On Saturday we will be open until 6 p.m. We will have huge crowds at Borsheim's throughout the weekend. For your convenience, therefore, shareholder prices will be available from Monday, April 26th through Saturday, May 8th. During that period, please identify yourself as a shareholder by presenting your meeting credentials or a brokerage statement that shows you are a Berkshire holder. Enter with rhinestones, leave with diamonds. My daughter tells me that the more you buy, the more you save. Kids say the darndest things. On Sunday, in the mall outside of Borsheim's, a blindfolded Patrick Wolf, twice U.S. chess champion, will take on all comers who will have the areas wide open in groups of 6. Nearby, Norman Beck, a remarkable magician from Dallas, will bewilder onlookers. Our special treat for shareholders this year will be the return of my friend, Ariel Singh, the country's top-ranked junior table tennis player, and a good bet to win at the Olympics someday. Now 14, Ariel came to the annual meeting 4 years ago and demolished all comers, including me. You can witness my humiliating defeat on YouTube. Just type in Ariel Singh Berkshire. Naturally, I've been plotting a comeback and will take her on outside of Borsheim's at 1 p.m. on Sunday. It will be a 3-point match, and after I soften her up, all shareholders are invited to try their luck at similar 3-point contests. Winners will be given a box of See's candy. We will have equipment available, but bring your own paddle if you think it will help. It won't. Gorat's will again be open exclusively for Berkshire shareholders on Sunday, May 2nd, and will be serving from 1 p.m. until 10 p.m. Last year, though, it was overwhelmed by demand. With many more diners expected this year, I've asked my friend, Donna Sheehan, at Piccolo's, another favorite restaurant of mine, to serve shareholders on Sunday as well. Piccolo's giant root beer float is mandatory for any fan of fine dining. You plan to eat at both restaurants. All of the weekend action makes me really hungry, and I have favorite dishes at each spot. Remember, to make a reservation at Gorat's, call 402-551-3733 on April 1st, but not before, and at Piccolo's call 402-342-9038. Regrettably, we will not be able to have a reception for international visitors this year. Our count grew to about 800 last year, and my simply signing one item per person took about 2.5 hours. Since we expect even more international visitors this year, Charlie and I decided we must drop this function. But be assured, we welcome every international visitor who comes. Last year we changed our method of determining what questions would be asked at the meeting, and received many dozens of letters applauding the new arrangement. We will therefore again have the same 3 financial journalists lead the question and answer period, asking Charlie and me questions that shareholders have submitted to them by email. The journalists and their email addresses are Carol Loomis, of Fortune, who may be emailed at clumis@fortunemail.com, Becky Quick, of CNBC, at berkshirequestions@cnbc.com, and Andrew Ross Sorkin, of the New York Times, at rsorkin@nytimes.com. From the questions submitted, each journalist will choose the dozen or so he or she decides are the most interesting and important. The journalists have told me your question has the best chance of being selected if you keep it concise and include no more Thanto questions in any email you send them. In your email, let the journalists know if you would like your name mentioned if your question is selected. Neither Charlie nor I will get so much as a clue about the questions to be asked. We know the journalists will pick some tough ones, and that's the way we like it. We will again have a drawing at 8 to 15 on Saturday at each of 13 microphones for those shareholders wishing to ask questions themselves. At the meeting, it will alternate the questions asked by the journalists with those from the winning shareholders. We've added 30 minutes to the question time, and will probably have time for about 30 questions from each group. At 86 and 79, Charlie and I remain lucky beyond our dreams. We were born in America, had terrific parents who saw that we got good educations, have enjoyed wonderful families and great health, and came equipped with a business gene that allows us to prosper, in a manner hugely disproportionate to that experienced by many people who contribute as much or more to our society's well-being. Moreover, we have long had jobs that we love, in which we are helped in countless ways by talented and cheerful associates. Indeed, over the years, our work has become ever more fascinating. No wonder we tap dance to work. If pushed, we would gladly pay substantial sums to have our jobs, but don't tell the comp committee. Nothing, however, is more fun for us than getting together with our shareholder partners at Berkshire's annual meeting. So join us on May 1st at the Q West for our annual Woodstock for Capitalists. We'll see you there. The 26th of February 2010. Warren E. Buffett, Chairman of the Board. P.S. Come by rail. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated. The per-share book value of both our Class A and Class B stock increased by 13% in 2010. Over the last 46 years, that is, since present management took over, book value has grown from $19 to $95,453, a rate of 20.2% compounded annually. Asterisk. All per-share figures used in this report apply to Berkshire's A shares. Figures for the B shares are 1/1,000, 500th of those shown for A. The highlight of 2010 was our acquisition of Burlington Northern Santa Fe, a purchase that's working out even better than I expected. It now appears that owning this railroad will increase Berkshire's normal earning power by nearly 40% pre-tax and by well over 30% after tax. Making this purchase increased our share count by 6% and used $22 billion of cash. Since we've quickly replenished the cash, the economics of this transaction have turned out very well. A normal year, of course, is not something that either Charlie Munger, Vice Chairman of Berkshire and my partner, or I can define with any precision, but for the purpose of estimating our current earning power, we are envisioning a year free of a mega catastrophe in insurance, and possessing a general business climate somewhat better than that of 2010 but weaker than that of 2005 or 2006. Using these assumptions, and several others that I will explain in the investment section, I can estimate that the normal earning power of the assets we currently own is about $17 billion pre-tax and $12 billion after tax, excluding any capital gains or losses. Every day Charlie and I think about how we can build on this base. Both of us are enthusiastic about BNSF's future because railroads have major cost and environmental advantages over trucking, their main competitor. Last year, BNSF moved each ton of freight. It carried a record 500 miles on a single gallon of diesel fuel. That's 3 times more fuel efficient than trucking is, which means our railroad owns an important advantage in operating costs. Concurrently, our country gains because of reduced greenhouse emissions and a much smaller need for imported oil. When traffic travels by rail, society benefits. Over time, the movement of goods in the United States will increase, and BNSF should get its full share of the gain. The railroad will need to invest massively to bring about this growth, but no one is better situated than Berkshire to supply the funds required. However slow the economy, or chaotic the markets, our checks will clear. Last year, in the face of widespread pessimism about our economy, we demonstrated our enthusiasm for capital investment at Berkshire by spending $6 billion on property and equipment. Of this amount, $5.4 billion or 90% of the total was spent in the United States. Certainly our businesses will expand abroad in the future, but an overwhelming part of their future investments will be at home. In 2011, we will set a new record for capital spending $8 billion and spend all of the $2 billion increase in the United States. Money will always flow toward opportunity, and there is an abundance of that in America. Commentators today often talk of great uncertainty. But think back, for example, to the 6th of December 1941, the 18th of October 1987, and September 10, 2001. No matter how serene today may be, tomorrow is always uncertain. Don't let that reality spook you. Throughout my lifetime, politicians and pundits have constantly moaned about terrifying problems facing America. Yet our citizens now live an astonishing 6 times better than when I was born. The prophets of doom have overlooked the all-important factor that is certain. Human potential is far from exhausted, and the American system for unleashing that potential, a system that has worked wonders for over 2 centuries despite frequent interruptions for recessions and even a civil war, remains alive and effective. We are not natively smarter than we were when our country was founded, nor do we work harder. But look around you and see a world beyond the dreams of any colonial citizen. Now, as in 1776, 1861, 1932, and 1941, America's best days lie ahead. Performance. Charlie and I believe that those entrusted with handling the funds of others should establish performance goals at the onset of their stewardship. Lacking such standards, managements are tempted to shoot the arrow of performance and then paint the bullseye around wherever it lands. In Berkshire's case, we long ago told you that our job is to increase per-share intrinsic value at a rate greater than the increase, including dividends, of the S&P 500. In some years we succeed, in others we fail. But if we are unable over time to reach that goal, we have done nothing for our investors, who by themselves could have realized an equal or better result by owning an index fund. The challenge, of course, is the calculation of intrinsic value. Present that task to Charlie and me separately, and you will get 2 different answers. Precision just isn't possible. To eliminate subjectivity, we therefore use an understated proxy for intrinsic value, book value, when measuring our performance. To be sure, some of our businesses are worth far more than their carrying value on our books. Later in this report, we'll present a case study. But since that premium seldom swings wildly from year to year, book value can serve as a reasonable device for tracking how we are doing. The table on page 2 shows our 46-year record against the S&P, a performance quite good in the earlier years and now only satisfactory. The bountiful years, we want to emphasize, will never return. The huge sums of capital we currently manage eliminate any chance of exceptional performance. We will strive, however, for better than average results and feel it fair for you to hold us to that standard. Yearly figures, it should be noted, are neither to be ignored nor viewed as all important. The pace of the Earth's movement around the sun is not synchronized with the time required for either investment ideas or operating decisions to bear fruit. At Geico, for example, we enthusiastically spent $900 million last year on advertising to obtain policyholders who deliver us no immediate profits. If we could spend twice that amount productively, would happily do so, though short-term results would be further penalized. Many large investments at our railroad and utility operations are also made with an eye to payoffs well down the road. To provide you a longer-term perspective on performance, we present on the facing page the yearly figures from page 2, recast into a series of 5-year periods. Overall, there are 42 of these periods, and they tell an interesting story. On a comparative basis, our best years ended in the early 1980 seconds. The market's golden period, however, came in the 17 following years, with Berkshire achieving stellar absolute returns even as our relative advantage narrowed. After 1999, the market stalled. Or have you already noticed that? Consequently, the satisfactory performance relative to the S&P that Berkshire has achieved since then has delivered only moderate absolute results. Looking forward, we hope to average several points better than the S&P, though that result is, of course, far from a sure thing. If we succeed in that aim, we will almost certainly produce better relative results in bad years for the stock market and suffer poorer results in strong markets. Intrinsic value today and tomorrow. Though Berkshire's intrinsic value cannot be precisely calculated, two of its three key pillars can be measured. Charlie and I rely heavily on these measurements when we make our own estimates of Berkshire's value. The first component of value is our investments: stocks, bonds, and cash equivalents. At year-end, these totaled $158 billion at market value. Insurance float money we temporarily hold in our insurance operations. That does not belong to us funds $66 billion of our investments. This float is free, as long as insurance underwriting breaks even, meaning that the premiums we receive equal the losses and expenses we incur. Of course, underwriting results are volatile, swinging erratically between profits and losses. Over our entire history, though, we've been significantly profitable, and I also expect us to average break-even results or better in the future. If we do that, all of our investments, those funded both by float and by retained earnings, can be viewed as an element of value for Berkshire shareholders. Berkshire's second component of value is earnings that come from sources other than investments and insurance underwriting. These earnings are delivered by our 68 non-insurance companies, itemized on page 106. In Berkshire's early years, we focused on the investment side. During the past 2 decades, however, we've increasingly emphasized the development of earnings from non-insurance businesses, a practice that will continue. The following tables illustrate this shift. In the first table, we present per-share investments at decade intervals beginning in 1970, 3 years after we entered the insurance business. We exclude those investments, though our compounded annual increase in per-share investments was a healthy 19.9% over the 40-year period. Our rate of increase has slowed sharply as we have focused on using funds to buy operating businesses. The payoff from this shift is shown in the following table, which illustrates how earnings of our non-insurance businesses have increased, again on a per-share basis, and after applicable minority interests. For the 40 years, our compounded annual gain in pre-tax, non-insurance earnings per share is 21%. During the same period, Berkshire's stock price increased at a rate of 22.1% annually. Over time, you can expect our stock price to move in rough tandem with Berkshire's investments and earnings. Market price and intrinsic value often follow very different paths, sometimes for extended periods, but eventually they meet. There is a third, more subjective element to an intrinsic value calculation that can be either positive or negative: the efficacy with which retained earnings will be deployed in the future. We, as well as many other businesses, are likely to retain earnings over the next decade that will equal or even exceed the capital we presently employ. Some companies will turn these retained dollars into 50-cent pieces, others into $2 bills. This, what will they do with the money factor, must always be evaluated along with the what do we have now calculation in order for us, or anybody, to arrive at a sensible estimate of a company's intrinsic value. That's because an outside investor stands by helplessly as management reinvests his share of the company's earnings. If a CEO can be expected to do this job well, the reinvestment prospects add to the company's current value. If the CEO's talents or motives are suspect, today's value must be discounted. The difference in outcome can be huge. $1 of then value in the hands of Sears Roebuck's or Montgomery Ward's CEOs in the late 1960 shad a far different destiny than did $1 entrusted to Sam Walton. Charlie and I hope that the per-share earnings of our non-insurance businesses continue to increase at a decent rate, but the job gets tougher as the numbers get larger. We will need both good performance from our current businesses and more major acquisitions. We're prepared. Our elephant gun has been reloaded and my trigger finger is itchy. Partially offsetting our anchor of size are several important advantages we have. First, we possess a cadre of truly skilled managers who have an unusual commitment to their own operations and to Berkshire. Many of us CEOs are independently wealthy and work only because they love what they do. They are volunteers, not mercenaries. Because no one can offer them a job they would enjoy more, they can't be lured away. At Berkshire, managers can focus on running their businesses. They are not subjected to meetings at headquarters, nor financing worries, nor Wall Street harassment. They simply get a letter from me every 2 years, reproduced at the end of this letter, and call me when they wish. And their wishes do differ. There are managers to whom I have not talked in the last year, while there is one with whom I talk almost daily. Our trust is in people rather than process. A hire well, manage little code suits both them and me. Berkshire CEOs come in many forms. Some have MBAs, others never finished college. Some use budgets and are by the book types, others operate by the seat of their pants. Our team resembles a baseball squad composed of all-stars having vastly different batting styles. Changes in our lineup are seldom required. Our second advantage relates to the allocation of the money our business sees earn. After meeting the needs of those businesses, we have very substantial sums left over. Most companies limit themselves to reinvesting funds within industry in which they have been operating. That often restricts them, however, to a universe for capital allocation that is both tiny and quite inferior to what is available in the wider world. Competition for the few opportunities that are available tends to become fierce. The seller has the upper hand, as a girl might if she were the only female at a party attended by many boys. That lopsided situation would be great for the girl, but terrible for the boys. At Berkshire, we face no institutional restraints when we deploy capital. Charlie and I are limited only by our ability to understand the likely future of a possible acquisition. If we clear that hurdle, and frequently we can't, we are then able to compare any one opportunity against a host of others. When I took control of Berkshire in 1965, I didn't exploit this advantage. Berkshire was then only in textiles, where it had in the previous decade lost significant money. The dumbest thing I could have done was to pursue opportunities to improve and expand the existing textile operation, so for years, that's exactly what I did. And then, in a final burst of brilliance, I went out and bought another textile company. Eventually I came to my senses, heading first into insurance and then into other industries. There is even a supplement to this world as our oyster advantage. In addition to evaluating the attractions of one business against a host of others, we all sum our businesses against opportunities available in marketable securities, a comparison most managements don't make. Often, businesses are priced ridiculously high against what can likely be earned from investments in stocks or bonds. At such moments, we buy securities and bide our time. Our flexibility in respect to capital allocation has accounted for much of our progress to date. We have been able to take money we earn from, say, See's Candies or Business Wire, two of our best-run businesses, but also two offering limited reinvestment opportunities, and use it as part of the stake we needed to buy BNSF. Our final advantage is the hard-to-duplicate culture that permeates Berkshire. And in businesses, culture counts. To start with, the directors who represent you think and act like owners. They receive token compensation, no options, no restricted stock, and, for that matter, virtually no cash. We do not provide them directors' and officers' liability insurance, a given at almost every other large public company. If they mess up with your money, they will lose their money as well. Leaving my holdings aside, directors and their families own Berkshire shares worth more than $3 billion. Our directors, therefore, monitor Berkshire's actions and results with keen interest and an owner's eye. You and I are lucky to have them as stewards. This same owner orientation prevails among our managers. In many cases, these are people who have sought out Berkshire as an acquirer for a business that they and their families have long owned. They came to us with an owner's mindset, and we provide an environment that encourages them to attain it. Having managers who love their businesses is no small advantage. Cultures self-propagate. Winston Churchill once said, "You shape your houses and then they shape you." That wisdom applies to businesses as well. Bureaucratic procedures beget more bureaucracy, and imperial corporate palaces induce imperious behavior. As one wag put it, you know you're no longer CEO when you get in the back seat of your car and it doesn't move. At Berkshire's world headquarters, our annual rent is $270,212. Moreover, the home office investment in furniture, art, Coke dispenser, lunchroom, high-tech equipment, you name it, totals $301,363. As long as Charlie and I treat your money as if it were our own, Berkshire's managers are likely to be careful with it as well. Our compensation programs, our annual meeting, and even our annual reports are all designed with an eye to reinforcing the Berkshire culture and making it one that will repel and expel managers of a different bent. This culture grows stronger every year, and it will remain intact long after Charlie and I have left the scene. We will need all of the strengths I've just described to do reasonably well. Our managers will deliver. You can count on that. But whether Charlie and I can hold up our end in capital allocation depends in part on the competitive environment for acquisitions. You will get our best efforts. Geico. Now let me tell you a story that will help you understand how the intrinsic value of a business can far exceed its book value. Relating this tale also gives me a chance to relive some great memories. 60 years ago last month, Geico entered my life, destined to shape it in a huge way. I was then a 20-year-old graduate student at Columbia, having elected to go there because my hero, Ben Graham, taught a once-a-week class at the school. One day at the library, I checked out Ben's entry in Who's Who in America and found he was chairman of Government Employees Insurance Co., now called Geico. I knew nothing of insurance, and had never heard of the company. The librarian, however, steered me to a large compendium of insurers, and, after reading the page on Geico, I decided to visit the company. The following Saturday, I boarded an early train for Washington. Alas, when I arrived at the company's headquarters, the building was closed. I then rather frantically started pounding on a door, until finally, a janitor appeared. I asked him if there was anyone in the office I could talk to, and he steered me to the only person around, Lorimer Davidson. That was my lucky moment. During the next 4 hours, Davy gave me an education about both insurance and Geico. It was the beginning of a wonderful friendship. Soon thereafter, I graduated from Columbia and became a stock salesman in Omaha. Geico, of course, was my prime recommendation, which got me off to a great start with dozens of customers. Geico also jump-started my net worth because, soon after meeting Davy, it made the stock 75% of my $9,800 investment portfolio. Even so, I felt over-diversified. Subsequently, Davy became CEO of Geico, taking the company town dreamed of heights before it got into trouble in the mid-1970s, a few years after his retirement. When that happened, with the stock falling by more than 95%, Berkshire bought about 1/3 of the company in the market, a position that over the years increased to 50% because of Geico's repurchases of its own shares. Berkshire's cost for this half of the business was $46 million. Despite the size of our position, we exercised no control over operations. We then purchased the remaining 50% of Geico at the beginning of 1996, which spurred Davy, at 95, to make a videotape saying how happy he was that his beloved Geico would permanently reside with Berkshire. He also playfully concluded with, "Next time, Warren, please make an appointment." A lot has happened at Geico during the last 60 years, but its core goal, saving Americans substantial money on their purchase of auto insurance, remains unchanged. Try us at 1-800-847-7536 or www.geico.com. In other words, get the policyholder's business by deserving his business. Focusing on this objective, the company has grown to be America's third-largest auto insurer, with a market share of 8.8%. When Tony Nicely, Geico's CEO, took over in 1993, that share was 2.0%, a level at which it had been stuck for more than a decade. Geico became a different company under Tony, finding a path to consistent growth while simultaneously maintaining underwriting discipline and keeping its costs low. Let me quantify Tony's achievement. When, in 1996, we bought the 50% of Geico we didn't already own, it cost us about $2.3 billion. That price implied a value of $4.6 billion for 100%. Geico then had tangible net worth of $1.9 billion. The excess over tangible net worth of the implied value $2.7 billion was what we estimated Geico's goodwill to be worth at that time. That goodwill represented the economic value of the policyholders who were then doing business with Geico. In 1995, those customers had paid the company $2.8 billion in premiums. Consequently, we were valuing Geico's customers at about 97%, 8, of what they were annually paying the company. By industry standards, that was a very high price. But Geico was no ordinary insurer. Because of the company's low costs, its policyholders were consistently profitable and unusually loyal. Today, premium volume is $14.3 billion and growing. Yet we carry the goodwill of Geico on our books at only $1.4 billion, an amount that will remain unchanged no matter how much the value of Geico increases. Under accounting rules, you write down the carrying value of goodwill if its economic value decreases, but leave it unchanged if economic value increases. Using the 97% of premium volume yardstick we applied to our 1996 purchase, the real value today of Geico's economic goodwill is about $14 billion. And this value is likely to be much higher 10 and 20 years from now. Geico, off to a strong start in 2011, is the gift that keeps giving. One not so small. Footnote. Under Tony, Geico has developed one of the country's largest personal lines insurance agencies, which primarily sell homeowners policies to our Geico auto insurance customers. In this business, we represent a number of insurers that are not affiliated with us. They take the risk, we simply sign up the customers. Last year we sold 769,898 new policies at this agency operation, up 34% from the year before. The obvious way this activity aids us is that it produces commission revenue. Equally important is the fact that it further strengthens our relationship with our policyholders, helping us retain them. I owe an enormous debt to Tony and Davy, and, come to think of it, to that janitor as well. Now, let's examine the four major sectors of Berkshire. Each has vastly different balance sheet and income characteristics from the others. Lumping them together, therefore, impedes analysis. So we'll present them as four separate businesses, which is how Charlie and I view them. We will look first at insurance, Berkshire's core operation, and the engine that has propelled our expansion over the years. Insurance. Property casualty, P.C. Insurers receive premiums upfront and pay claims later. In extreme cases, such as those arising from certain workers' compensation accidents, payments can stretch over decades. This collect, now, pay later model leaves us holding large sums money we call float that will eventually go to others. Meanwhile, we get to invest this float for Berkshire's benefit. Though individual policies and claims come and go, the amount of float we hold remains remarkably stable in relation to premium volume. Consequently, as our business grows, so does our float. And how we have grown. Just take a look at the following table. If our premiums exceed the total of our expenses and eventual losses, we register an underwriting profit that adds to the investment income that our float produces. When such a profit occurs, we enjoy the use of free money, and, better yet, get paid for holding it. Alas, the wish of all insurers to achieve this happy result creates intense competition, so vigorous in most years that it causes the P.C. industry as a whole to operate at a significant underwriting loss. This loss, in effect, is what the industry pays to hold its float. For example, State Farm, by far the country's largest insurer and a well-managed company, has incurred an underwriting loss in 7 of the last 10 years. During that period, its aggregate underwriting loss was more than $20 billion. At Berkshire, we have now operated at an underwriting profit for 8 consecutive years, our total underwriting gain for the period having been $17 billion. I believe it likely that we will continue to underwrite profitably in most, though certainly not all future years. If we accomplish that, our float will be better than cost-free. We will benefit just as we would if some party deposited $66 billion with us, paid us a fee for holding its money, and then let us invest its funds for our own benefit. Let me emphasize again that cost-free float is not an outcome to be expected for the P.C. industry as a whole. In most years, industry premiums have been inadequate to cover claims plus expenses. Consequently, the industry's overall return on tangible equity has for many decades fallen far short of the average return realized by American industry, a sorry performance almost certain to continue. Berkshire's outstanding economics exist only because we have some terrific managers running some unusual businesses. We've already told you about Geico, but we have 2 other very large operations, and a bevy of smaller ones as well, each a star in its own way. First off, is the Berkshire Hathaway Reinsurance Group, run by Ajit Jain. Ajit insures risks that no one else has the desire or the capital to take on. His operation combines capacity, speed, decisiveness, and most importantly, brains in a manner that is unique in the insurance business. Yet he never exposes Berkshire to risks that are inappropriate in relation to our resources. Indeed, we are far more conservative than most large insurers in that respect. In the past year, Ajit has significantly increased his life reinsurance operation, developing annual premium volume of about $2 billion that will repeat for decades. From a standing start in 1985, Ajit has created an insurance business with float of $30 billion and significant underwriting profits, a feat that no CEO of any other insurer has come close to matching. By his accomplishments, he has added a great many billions of dollars to the value of Berkshire. Even kryptonite bounces off Ajit. We have another insurance powerhouse in General Re, managed by Tad Montrose. At bottom, a sound insurance operation requires 4 disciplines. 1. An understanding of all exposures that might cause a policy to incur losses. 2. A conservative evaluation of the likelihood of any exposure actually causing a loss and the probable cost if it does. 3. The setting of a premium that will deliver a profit, on average, after both prospective loss costs and operating expenses are covered. And 4. The willingness to walk away if the appropriate premium can't be obtained. Many insurers pass the first 3 tests and flunk the 4th. The urgings of Wall Street, pressures from the agency force and brokers, or simply a refusal by a testosterone-driven CEO to accept shrinking volumes has led too many insurers to write business at inadequate prices. The other guy is doing it, so must as well. Spells trouble in any business, but none more so than insurance. Tad has observed all 4 of the insurance commandments, and it shows in his results. General Re's huge float has been better than cost-free under his leadership, and we expect that, on average, it will continue to be. Finally, we own a group of smaller companies, most of them specializing in odd corners of the insurance world. In aggregate, their results have consistently been profitable and, as the table below shows, the float they provide us is substantial. Charlie and I treasure these companies and their managers. Here is the record of all 4 segments of our property casualty and life insurance businesses. Among large insurance operations, Berkshire's impresses me as the best in the world. Manufacturing, service and retailing operations. Our activities in this part of Berkshire cover the waterfront. Let's look, though, at a summary balance sheet and earnings statement for the entire group. This group of companies sells products ranging from lollipops to jet airplanes. Some of the businesses enjoy terrific economics, measured by earnings on unleveraged net tangible assets that run from 25% after tax to more than 100%. Others produce good returns in the area of 12–20%. Unfortunately, a few have very poor returns, a result of some serious mistakes I have made in my job of capital allocation. These errors came about because I misjudged either the competitive strength of the business I was purchasing or the future economics of the industry in which it operated. I try to look out 10 or 20 years when making an acquisition, but sometimes my eyesight has been poor. Most of the companies in this section improved their earnings last year, and 4 set records. Let's look first at the record breakers. TTI, our electronic components distributor, had sales 21% above its previous high, recorded in 2008, and pre-tax earnings that topped its earlier record by 58%. Its sales gains spanned 3 continents, with North America at 16%, Europe at 26%, and Asia at 50%. The thousands of items TTI distributes are pedestrian, many selling for less than $1. The magic of TTI's exceptional performance is created by Paul Andrews, its CEO, and his associates. Forest River, our RV and boat manufacturer, had record sales of nearly $2 billion and record earnings as well. Forest River has 82 plants, and I have yet to visit one, or the home office for that matter. There's known. Pete Legal, the company's CEO, runs a terrific operation. Come view his products at the annual meeting. Better yet, buy one. CTB, our farm equipment company, again set an earnings record. I told you in the 2008 annual report about Vic Mancinelli, the company's CEO. He just keeps getting better. Berkshire paid $140 million for CTB in 2002. It has since paid us dividends of $160 million and eliminated $40 million of debt. Last year, it earned $106 million pre-tax. Productivity gains have produced much of this increase. When we bought CTB, sales per employee were $189,365. Now they are $405,878. Would you believe shoes? HHH. Brown, run by Jim Isler and best known for its Bourne brand, set a new record for sales and earnings, helped by it selling 1,110 pairs of shoes at our annual meeting. Jim has brilliantly adapted to major industry changes. His work, I should mention, is overseen by Frank Rooney, 89, a superb businessman and still a dangerous fellow with whom to have a bet on the golf course. A huge story in this sector's year-to-year improvement occurred at NetJets. I can't overstate the breadth and importance of Dave Sokol's achievements at this company, the leading provider of fractional ownership of jet airplanes. NetJets has long been an operational success, owning a 2010 market share 5 times that of its nearest competitor. Our overwhelming leadership stems from a wonderful team of pilots, mechanics, and service personnel. This crew again did its job in 2010, with customer satisfaction, as delineated in our regular surveys, hitting new highs. Even though NetJets was consistently a runaway winner with customers, our financial results, since its acquisition in 1998, were a failure. In the 11 years through 2009, the company reported an aggregate pre-tax loss of $157 million, a figure that was far understated since borrowing costs at NetJets were heavily subsidized by its free use of Berkshire's credit. Had NetJets been operating on a standalone basis, its loss over the years would have been several hundreds of millions greater. We are now charging NetJets an appropriate fee for Berkshire's guarantee. Despite this fee, which came to $38 million in 2010, NetJets earned $207 million pre-tax in 2010, a swing of $918 million from 2009. Dave's quick restructuring of management, and the company's rationalization of its purchasing and spending policies, has ended the hemorrhaging of cash and turned what was Berkshire's only major business problem into a solidly profitable operation. Dave has meanwhile maintained NetJet's industry-leading reputation for safety and service. In many important ways, our training and operational standards are considerably stronger than those required by the FAA. Maintaining top-of-the-line standards is the right thing to do, but I also have a selfish reason for championing this policy. My family and I have flown more than 5,000 hours on NetJets. That's equal to being airborne 24 hours a day for 7 months, and will fly thousands of hours more in the future. We receive no special treatment and have used a random mix of at least 100 planes and 300 crews. Whichever the plane or crew, we always know we are flying with the best trained pilots in private aviation. The largest earner in our manufacturing, service and retailing sector is Marmon, a collection of 130 businesses. We will soon increase our ownership in this company to 80% by carrying out our scheduled purchase of 17% of its stock from the Pritzker family. The cost will be about $1.5 billion. We will then purchase the remaining Pritzker holdings in 2013 or 2014, whichever date is selected by the family. Frank Tack runs Marmon wonderfully, and we look forward to 100% ownership. Next to Marmon, the two largest earners in this sector are Iskar and McLean. Both had excellent years. In 2010, Grady Rosier's McLean entered the wine and spirits distribution business to supplement its $32 billion operation as a distributor of food products, cigarettes, candy and sundries. In purchasing Empire Distributors, an operator in Georgia and North Carolina, we teamed up with David Kahn, the company's dynamic CEO. David is leading our efforts to expand geographically. By year-end he had already made his first acquisition, Horizon Wine and Spirits in Tennessee. At Iskar, profits were up 159% in 2010, and we may well surpass pre-recession levels in 2011. Sales are improving throughout the world, particularly in Asia. Credit Eitan Wertheimer, Jacob Harpaz and Danny Goldman for an exceptional performance, one far superior to that of Iskar's main competitors. All that is good news. Our businesses related to home construction, however, continue to struggle. Johns Manville, Mytech, Shaw, and Acme Brick have maintained their competitive positions, but their profits are far below the levels of a few years ago. Combined, these operations earned $362 million pre-tax in 2010, compared to $1.3 billion in 2006, and their employment has fallen by about 9,400. A housing recovery will probably begin within a year or so. In any event, it is certain to occur at some point. Consequently, 1. At Mytech, we have made or committed to 5 bolt-on acquisitions during the past 11 months. 2. At Acme, we just recently acquired the leading manufacturer of brick in Alabama for $50 million. 3. Johns Manville is building a $55 million roofing membrane plant in Ohio to be completed next year. And 4. Shaw will spend $200 million in 2011 on plant and equipment. All of It's situated in America. These businesses entered the recession strong and will exit it stronger. At Berkshire, our time horizon is forever. Regulated, capital-intensive businesses. We have two very large businesses, BNSF and Mid-American Energy, with important common characteristics that distinguish them from our many others. Consequently, we give them their own sector in this letter and split out their financial statistics in our GAAP balance sheet and income statement. A key characteristic of both companies is the huge investment they have in very long-lived regulated assets, with these funded by large amounts of long-term debt that is not guaranteed by Berkshire. Our credit is not needed. Both businesses have earning power that, even under very adverse business conditions, amply covers their interest requirements. For example, in recessionary 2010 with BNSF's car loadings far off peak levels, the company's interest coverage was 6-1. Both companies are heavily regulated, and both will have a never-ending need to make major investments in plant and equipment. Both also need to provide efficient, customer-satisfying service to earn the respect of their communities and regulators. In return, both need to be assured that they will be allowed to earn reasonable earnings on future capital investments. Earlier I explained just how important railroads are to our country's future. Rail moves 42% of America's intercity freight, measured by ton miles, and BNSF moves more than any other railroad, about 28% of the industry total. A little math will tell you that more than 11% of all intercity ton-mile soft freight in the U.S. is transported by BNSF. Given the shift of population to the west, our share may well inch higher. All of this adds up to a huge responsibility. We are a major and essential part of the American economy's circulatory system, obliged to constantly maintain and improve our 23,000 miles of track, along with its ancillary bridges, tunnels, engines, and cars. In carrying out this job, we must anticipate society's needs, not merely react to them. Fulfilling our societal obligation, we will regularly spend far more than our depreciation, with this excess amounting to $2 billion in 2011. I'm confident we will earn appropriate returns on our huge incremental investments. Wise regulation and wise investment are two sides of the same coin. At Mid-American, we participate in a similar social compact. We are expected to put up ever-increasing sums to satisfy the future needs of our customers. If we meanwhile operate reliably and efficiently, we know that we will obtain a fair return on these investments. Mid-American supplies 2.4 million customers in the U.S. with electricity, operating as the largest supplier in Iowa, Wyoming, and Utah, and as an important provider in other states as well. Our pipelines transport 8% of the country's natural gas. Obviously, many millions of Americans depend on use every day. Mid-American has delivered outstanding results for both its owners. Berkshire's interest is 89.8% and its customers. Shortly after Mid-American purchased Northern Natural Gas Pipeline in 2002, that company's performance as a pipeline was rated dead last 43 out of 43 by the leading authority in the field. In the most recent report published, Northern Natural was ranked second. The top spot was held by our other pipeline, Kern River. In its electric business, Mid-American has a comparable record. Iowa rates have not increased since we purchased our operation there in 1999. During the same period, the other major electric utility in the state has raised prices more than 70% and now has rates far above ours. In certain metropolitan areas in which the two utilities operate side by side, electric bills of our customers run far below those of their neighbors. I am told that comparable houses sell at higher prices in these cities if they are located in our service area. Mid-American will have 2,909 megawatts of wind generation in operation by the end of 2011, more than any other regulated electric utility in the country. The total amount that Mid-American has invested or committed to wind is a staggering $5.4 billion. We can make this sort of investment because Mid-American retains all of its earnings, unlike other utilities that generally pay out most of what they earn. As you can tell by now, I am proud of what has been accomplished for our society by Matt Rose at BNSF, and by David Sokol and Greg Abel at Mid-American. I am also both proud and grateful for what they have accomplished for Berkshire shareholders. Below are the relevant figures. Finance and financial products. This, our smallest sector, includes 2 rental companies, Extra Trailers and Court Furniture, and Clayton Homes, the country's leading producer and financer of manufactured homes. Both of our leasing businesses improved their performances last year, albeit from a very low base. Extra increased the utilization of its equipment from 63% in 2009 to 75% in 2010, thereby raising pre-tax earnings to $35 million from $17 million in 2009. Court experienced a pickup in business as the year progressed and also significantly tightened its operations. The combination increased its pre-tax results from a loss of $3 million in 2009 to $18 million of profit in 2010. At Clayton, we produced 23,343 homes, 47% of the industry's total of 50,046. Contrast this to the peak year of 1998, when 372,843 homes were manufactured. We then had an industry share of 8%. Sales would have been terrible last year under any circumstances, but the financing problems I commented upon in the 2009 report continue to exacerbate the distress. To explain, home financing policies of our government, expressed through the loans found acceptable by FHA, Freddie Mac and Fannie Mae, favor site, built homes and work to negate the price advantage that manufactured homes offer. We finance more manufactured home buyers than any other company. Our experience, therefore, should be instructive to those parties preparing to overhaul our country's home loan practices. Let's take a look. Clayton owns 200,804 mortgages that it originated. It also has some mortgage portfolios that it purchased. At the origination of these contracts, the average FICO score of our borrowers was 648, and 47% were 640 or below. Your banker will tell you that people with such scores are generally regarded as questionable credits. Nevertheless, our portfolio has performed well during conditions of stress. Here's our loss experience. Our borrowers get in trouble when they lose their jobs, have health problems, get divorced, etc. The recession has hit them hard. But they want to stay in their homes, and generally they borrowed sensible amounts in relation to their income. In addition, we were keeping the originated mortgages for our own account, which means we were not securitizing or otherwise reselling them. If we were stupid in our lending, we were going to pay the price. That concentrates the mind. If home buyers throughout the country had behaved like our buyers, America would not have had the crisis that it did. Our approach was simply to get a meaningful down payment and gear fixed monthly payments to a sensible percentage of income. This policy kept Clayton solvent and also kept buyers in their homes. Homeownership makes sense for most Americans, particularly at today's lower prices and bargain interest rates. All things considered, the third best investment I ever made was the purchase of my home, though I would have made far more money had I instead rented and used the purchase money to buy stocks. The two best investments were wedding rings. For the $31,500 I paid for our house, my family and I gained 52 years of terrific memories with more to come. But a house can be a nightmare if the buyer's eyes are bigger than his wallet and, if a lender, often protected by a government guarantee, facilitates his fantasy. Our country's social goal should not be to put families into the house of their dreams, but rather to put them into a house they can afford. Investments. Below, we show our common stock investments that at year-end had a market value of more than $1 billion. In our reported earnings, we reflect only the dividends our portfolio companies pay us. Our share of the undistributed earnings of these investees, however, was more than $2 billion last year. These retained earnings are important. In our experience, and, for that matter, in the experience of investors over the past century, undistributed earnings have been either matched or exceeded by market gains, albeit in a highly irregular manner. Indeed, sometimes the correlation goes in reverse. As one investor said in 2009, "This is worse than divorce. I've lost half my net worth and I still have my wife." In the future, we expect our market gains to eventually at least equal the earnings our investees retain. In our earlier estimate of Berkshire's normal earning power, we made 3 adjustments that relate to future investment income, but did not include anything for the undistributed earnings factor I have just described. The first adjustment was decidedly negative. Last year, we discussed 5 large fixed income investments that have been contributing substantial sums to our reported earnings. One of these, our Swiss Re note, was redeemed in the early days of 2011, and 2 others, our Goldman Sachs and General Electric preferred stocks, are likely to be gone by year-end. General Electric is entitled to call our preferred in October and has stated its intention to do so. Goldman Sachs has the right to call our preferred on 30 days' notice, but has been held back by the Federal Reserve, bless it, which unfortunately will likely give Goldman the green light before long. All three of the companies redeeming must pay us a premium to do so, in aggregate about $1.4 billion, but all of the redemptions are nevertheless unwelcome. After they occur, our earning power will be significantly reduced. That's the bad news. There are two probable offsets. At year-end we held $38 billion of cash equivalents that have been earning a pittance throughout 2010. At some point, however, better rates will return. They will add at least $500 million, and perhaps much more, to our investment income. That sort of increase in money market yields is unlikely to come soon. It is appropriate, nevertheless, for us to include improved rates in an estimate of normal earning power, even before higher rates come about. Furthermore, we could get lucky and find an opportunity to use some of our cash hoard at decent returns. That day can't come too soon for me. To update Aesop, a girl in a convertible is worth 5 in the phone book. In addition, dividends on our current common stock holdings will almost certainly increase. The largest gain is likely to come at Wells Fargo. The Federal Reserve, our friend in respect to Goldman Sachs, has frozen dividend levels at major banks, whether strong or weak, during the last 2 years. Wells Fargo, though consistently prospering throughout the worst of the recession and currently enjoying enormous financial strength and earning power, has therefore been forced to maintain an artificially low payout. We don't fault the Fed. For various reasons, an across-the-board freeze-mad sense during the crisis and its immediate aftermath. At some point, probably soon, the Fed's restrictions will cease. Wells Fargo can then reinstate the rational dividend policy that its owners deserve. At that time, we would expect our annual dividends from just this one security to increase by several hundreds of millions of dollars annually.